Welcome, everybody, to our Straddles and Strangles webcast. I apologize for the technical issues I'm having there off the bat. I hate it when that happens. Anyway, I think we've got things squared away. Uh, we've talked about straddles, we've talked about strangles. We haven't talked about a strategy called a straddle strangle swap. All right, we're going to get into that today. If any of you know about that strategy, then you can just kind of have a leg up on everybody else. But we're actually going to be combining both of those strategies together. All right, I mentioned I'm joined in the chat with Brett Crowther. He'll help me answer some questions I can't quite get to. We're both on X, and I hope you're following us on X. I'm Connie Hill CS. Brett is Brett Crowther CS, and we'll post educational content, things that we find interesting in the market. We'll post about them so that you can know about them as well. All right, let's go through our disclosures and get down to business here. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for education and information only. Don't consider it a recommendation. We'll be using the Paper Money software application. It's what you download to your computer. It's the most robust version of Paper Money. It's a great learning environment, and I think a great place for you to practice when you have strategies or new rules you're trying out. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results. When we talk about costs here today, we're going to exclude any commissions, taxes, and fees, things of that nature. We just will not have them there. All right. Let's do this. I'm going to switch over here to my Thinkorswim platform. And really what we're going to do here as far as our agenda goes is a lot of this class, I think the important elements are how do you manage these kind of trades? How do you stay on top of them? And so forth. And I think there's a couple of questions out there about that. So we're going to go through the trades we went through last week before we get into our new trades today on that straddle strangle swap. All right. So last week we had CoreWeave. And on CoreWeave, initially it was projected in the market maker move, it had about 11.02% implied volatility for the market maker move. All right, so they were expecting the market to move either up or down about 11%, and it was one that did not disappoint in that manner. So on this, we had the 110 calls and the 100 puts, and we did a strangle. We did a long strangle. So we bought the call out of the money, the put out of the money, and that is our strangle. Now, the market maker move, which we use quite a bit in this class. Keep in mind, it's just theoretical in nature. It's not guaranteed that the stock is going to move that amount. All right, but it gives us an idea of what market makers have priced into the options. All right, because that helps us with our decision making. So on CoreWeave, I'm going to go ahead and just kind of zoom in here. We got in on this day, even which was a little bit before earnings, not a ton. That was the 10th when we were in our class, and they announced that night. So they announced their earnings after the market was closed. And initially in the aftermarket hours, what we could see is that the stock was moving down, but it's never guaranteed to open in the same place the next morning. That's just kind of a preliminary idea of what we think the stock's doing based on what the market's reaction is. And it did follow through with it. So the next day it gapped down very nicely and continued to drop. Now, in this case, what we did is because it dropped down and there was a pretty decent gap there, we went ahead and just tried to salvage what we could out of the call. We salvaged not a ton, okay, but we were able to salvage a little bit. Then the next day, it came up a little bit, all right, at the opening price, and it stayed there for a little bit of time, kind of like, oh, is this thing going to recover? It hit a stop that we had in place to try to lock in some profitability, but it ended up dropping down additionally the next day and the next day. And you can see on Friday, it looked like, oh, maybe it's trying to find a bottom here. So the question is, did we make enough to cover our premiums? And the answer is it was dang close, and it was not. I'm going to say it was kind of a break-even type trade. We go over here to the monitor tab. We look at CoreWeave. To do that initial strangle, it cost us $13.90 because this is kind of an expensive stock. The next morning, once those earnings came out, you could see at 7:32, we just sold the call for whatever we could get out of it. All right, which was $1.95. And so typically what I'll do is I'll say, okay, what's our net at that point? Our 13.90 minus $1.95, so that we have an idea, which was like $12.04, how much more we needed the option price to increase so we could know where we were breaking even. Okay. In our case, it went ahead and it took us out of the trade pretty quickly. So we actually only netted about 20 bucks in the trade, which is not a whole lot. But we followed our rules, and sometimes we just don't know what way it's going to go. Now, remember on these trades, long straddles, long strangles, they're speculative. They're, something that you're like, okay, I think it's going to move big, possibly, but we never know what direction that's going to be. We all get to find out together. Now, our other trade that we did, some of you said you did that in paper money. I'm interested to know how your trade turned out, if you were following along in paper money, if you got out at a similar time, or if you held on a little bit longer. Because had we held on a little bit longer to another day, we would have had a little bit more down movement that could have been a little bit more profitable for the trade. Okay. The other trade we did was Oklo. Now, Oklo actually was quite large as far as its implied volatility. It was 9.57% at that time that was priced into the market maker move. And so we got in. They weren't going to announce until the next day after the market closed. So this is on the 11th. They announced. So the first day of trading, it made this kind of a move. It went up a little bit. That give us enough of an idea if we think the call's going to win or the put's going to win? It really didn't. Okay, you're kind of like, I don't know, which way are you going to go? The next day, it came in and it started dropping down, but it really just has not moved a whole lot since that initial announcement. And ideally, if we're long a straddle or strangle, we need it to move. We get the implied volatility crush that comes out as soon as the announcement, which way it goes. Here's our implied volatility. We see it just really crush out of there. And really what we ended up with was the volatility crash on both the call and the put. And we did not make, we lost money on that trade. Okay. Eventually, if you're feeling time decay on both of your options, sometimes you're like, okay, I just need to be able to salvage something in the trade. So you're not taking a big loss on it. Okay, and that's what we ended up doing with Oklo. Now, you guys can tell me if you stayed in the trade a little bit longer, if you did that trade. We had the November 21 options. So technically, we could have stayed in it through until this coming Friday on the 21st. All right. Let's see, DJ or JDML or MI, you came out with a profit on it. Very good. You did it in paper. Excellent. When we're talking about practicing these trades, we always want it to be in your paper account. Okay. Very good. Ricebird said, wow, I'm not sure I can pronounce it that well. A straddle strangle swap, I think is what you're referring to there. All right. We're in the period of time where we don't have a ton of earnings. We still have some trickling in. This week, we have probably the biggest earnings that people have been waiting for in this particular earnings season, which is NVIDIA, right? All eyes are on NVIDIA and what they're doing. One thing that some of you have, because I have shared this, and I'm going to share it with those of you that are in here right now, that market maker move so that you can see on the chart where it's expected to go, up or down, whatever the dollar amount is, and then the percentage and the value showing up here as well. If you don't have that, this could be a handy script. Remember, when we share scripts with you, No, that was not the right. Let's try this again. When we share scripts with you, remember they're not guaranteed as to accuracy or timing. Okay. Let's try this here. Those of you that are in the live meeting, you'll see this in your chat. Those of you that aren't, when I go to the next screen we're going to take a look at, I'm going to paste it on there for you so you can pause, get the URL on that. All right, our first one we're going to take a look at. This could be a little bit interesting. Klarna Group. This is a fairly new IPO back here in September. So they have not gone through an earnings period yet. This is going to be the first earnings. Now, the reason that this one kind of caught my attention was because of how high the market maker move is, 14.92%. Yeah, so it's about 15%, which is one of the bigger ones I've ever seen. Okay, so is there an expectation of movement? There is, even though it's not based on history like we look at with a lot of our other straddles and strangles. Is it guaranteed to move that far? No. Could it just be, not do a whole lot like Oklo? Yeah, it could. We just really don't know. But the market's expecting a decent move here. Now, on this one, again, this is just speculative in nature. We're going to go ahead and sell the straddle on it with the idea that maybe it moves big, maybe it really doesn't. Maybe it stays between these boundaries, okay, and we get to keep the premium, okay? That's what we're going to look at. So stock right now is at 34.79, which means its 35 strike price is going to be our at the money straddle here. Now, I want to just review a little bit the risk that we have. If we have a naked call and a naked put, what does that do to us? Well, it puts us in a situation where we could have some real potential loss, right? On the put side of things, we're saying, okay, we're willing to take ownership of the stock, right? You can put it to us. Typically, that wouldn't happen unless the price of the stock went lower, right? Lower than the strike price. 35 is the one that we're going to end up using here right now. Now, what about the call? If we sell the call, the risk can be theoretically unlimited, right? Because we sell the call, we have to deliver that stock to somebody else. If this stock goes up big time, say maybe it's even bigger than the money market move. Okay, the money market move we've got in there in the neighborhood of about $5, okay? If it goes up even more than that, yeah, we could potentially be on the hook and have a pretty significant loss. But for illustrative purposes, we're going to go ahead and do a short strangle or short straddle. Okay, straddle means at the money on both those legs. Okay. Just for information, what is meant by the market maker move and how do we get that range? Great question. The market maker move is essentially what the market makers have priced into the at the money options. And so if we didn't even have the market maker move available to us, what we would do is we would add up call premium and put premium at the money. Okay, so we'd take 275 plus 250. That's in the neighborhood of about what? 525. And the market maker move up here is 516. So this is probably maybe taking the midpoint price, adding those together. And so it just gives us an idea of, well, this is what the market makers are pricing in. They're expecting a big move, and on a $35 stock, a $5 move, that's pretty significant. Yeah, it really is. And like I said, this is one of the bigger market maker moves I've seen in the past. Okay. So let's do this. We're going to sell the 35 put. We're going to sell the 35 call. It's going to bring in a credit. Gee, look at that credit. Look how close that credit is to the market maker price. Yeah, that MMM is basically that. Now, in this case, we're going to do it knowing that we do have potential, a lot on the line, right? Being short both the call and the put here. and the call being theoretically unlimited loss. Okay. Again, we're going to do this just for so you can get a flavor for maybe how this strategy might work, and then gives us the opportunity to manage it as well. So let's put this in our straddles and strangles bucket, and let's go ahead and send that in. All right. Let's move to the most probably talked about potential earnings coming up is NVIDIA. All right. Now, I'm surprised a little bit that the market maker move is not higher. In the past, this has been a big mover. How do we know that? You could go back to the last year, last 2 years, and just kind of see what it's been doing when they announce earnings. Are they making big moves? Are we seeing gaps in the chart? And NVIDIA typically has been a pretty big mover. However, the prices run up quite a bit. So maybe there's a lot already priced into the stock. And maybe there's a lot already priced into it. So maybe the expectation of movement isn't quite as big as maybe what it had been in the past, right? We keep coming to every earnings with NVIDIA and you're like, okay, well, they can't blow the top off again, can they? And then they seem to. And then the next earnings comes up. Well, they can't blow it off that much, right? But it seems to occur over and over again that it's been a decent mover. Okay, so you could go back and look. That one, that was quite a volatile candle day. That they announced it at night. These guys are going to announce on the, let's see what day that ended up being, the 19th, which is Wednesday after the market closes. Okay, so let's maybe just look at 3 months here. We bring that up. Let's see, the high point here, we're seeing at 212, and it's back down to 186. Percentage-wise, let's just see, let's measure that. We go to the peak here, and we're just going to go to the current price. That's in the neighborhood of a pullback. This is showing us about $26 and about a 12% off the high. Okay, and that's in a pretty short period of time that it's moved that percentage. All right, now enter the strategy that we're going to focus on here today, and that is the straddle strangle swap. And go ahead and chat in. Have any of you traded a straddle strangle swap before? If you have, I'd be curious. Raven Rag. Let me share that script again. I did post it in the chat initially earlier. All right, but let me just share that on the screen again there for the chat. All right. So NVIDIA, we know probably big news isn't going to break until they come out with whatever they're going to do. So the idea with this strategy is that we're going to sell a straddle. Okay, what's going to be our at the money? It looks like we've got 186 here. And what's going to be the closest? Probably on the 186, it's going to be the 185 strike. Okay. Earlier today, it was closer to the 187.50, but it's going to be, looks like now maybe the 185. And we're just going to go to the bid price. And I'm going to hold my control key down. We're going to sell the 185 put. We're going to sell the 185 call. And we're going to bring in a pretty decent premium here, $13.90. Now we're still in the same situation that we were with the first stock we took a look at and just did a short straddle on. We still have that unlimited risk. And that's where the second part kicks in here. We're going to sell the front month, in this case, the front week. And as we look at this, let's maybe look at, collapse all of that here. I want you to pay attention to the implied volatility priced into the November 21 options. So it's saying it's about 86%. Well, the next week out, that's going to be the 28th of November. Look how much difference there is in the implied volatility. It's like about 22, 23% more implied volatility is priced into those options that expire the week that the announcement comes up. And that's pretty common to see. So what we're going to do is we're going to buy a strangle. All right, that's going to be our protection for having two short legs out here. So we could go out as far as we want. Okay, we're just going to go out to the next week because the expectation is going to be hopefully it's going to make whatever move it's going to make, and then the play's going to be over. Trade's going to be over. So we probably don't need a lot of extra time. But if you want to go out further, you could. Okay. In this case, since we know our at the money is 185, we're going to go a little bit out of the money for the put and a little bit out of the money for the call, and we're going to be buying these. Okay, so we're not going to buy out the money, we're going to buy out of the money, which means we're going to be putting on a strangle, and that's why it's called a straddle strangle swap, the big SSS. Okay. All right, so here we're going to go about $5-ish out of the money. We're going to go 180 that we're going to buy here, and then we're going to go 190 here. All right, so there's our 190 call, our 180 put long. Now you're going to notice we still, in this case, that protection costs quite a bit, but look at it as maybe that the front month might be financing a little bit, actually the whole price, and we're going to start out here with a credit. Now, expectation is when they announce and we start looking at things Thursday morning, the implied volatility should come crushing out of those options, all of them, all across the board. Okay, so for our ones that we've sold short, hopefully we're expecting that it maybe doesn't move quite the market maker move. Okay, but we'll be able to kind of capture that implied volatility as it comes crushing out. Now we have a little bit more time for our long strangle. That's going to give us a little bit of protection for about a week longer, which if it does make a big move and we need to use one of those, we need to exercise one of them to help protect ourselves, then we can. Okay. I want you to see this in the risk profile. So we're going to do analyze trade. And by the way, it comes in here on the screen as a double diagonal because technically that's what it is. We're using different strike prices and different expiration dates. Okay. Where is the peak here? Well, the peak is right up here at that 185. Or take that back. Let's see. I've got an extra something on here. Let me delete that. That's probably from what I was looking at a little bit earlier. Because this is what the one we did, the 185 is 190. That looks better. Okay. So yeah, that peak's going to be at the short strike price of 185. But look at where our theoretical break-evens are. Theoretical break-even, maybe let me do a couple things here. Let's set the date up here. Set of November 22nd. We're going to change this to the furthest out date. So we're going to go to the 29th here. And then we're going to set slices to the break-even on the furthest date that it'll give us. It doesn't give us this date, but we go out the furthest that it will give us, which is going to be that 22nd. And then we can kind of see there's really quite a wide range that this could move. And you can see our break-even there looks like about in the neighborhood of, what does that say, 203 and some change, and clear down here at 169 and some change. Okay, that is a pretty broad range. So ideally, we're going to hold, ideally would hold till the options expire, say that front expires, or we get a big chunk out of it that we're pleased with. Okay, then we could potentially lock in our gains, remove the obligation from us. But in an ideal world, we'll probably close it all together. Okay, but we do have the option in case it moves big of that long call, that long put that we could exercise it if we needed to. All right, so let me see what kind of questions you have because I think you have quite a few here. So Kelly says, so it ends of a tight iron condor, but different time frames. It's actually not going to be that. Like I said, it's an iron condor is going to be a short credit spread and a short, well, two short credit spreads, right? One on the call side, one on the put side. So this is a little bit different than that. That's why I note here that technically it is a double diagonal. All right, let's see. JDL says it is easy to manage a double diagonal since there are two expiration dates. Now, I'm not sure if that was really a question or if that was a statement. I don't see a question, so it kind of looks to me like a statement. Okay. It looks like we have a survey that just popped in here. And you guys know from time to time we'll do a survey with you, right? Get your feedback on today's session in particular. And obviously we're not done, so you don't need to fill it out yet. But when you're done, go ahead and just click it right now so that you have the link sitting in the background. And then when it's time for you to leave or we finish the session, if you don't mind filling that out for us, our surveys are stinking easy, okay? There's 2 questions and you can just fill in the radio button on a scale of 1 to 10, how you feel, plop, plop, you could be done. Now there's a couple questions you can answer if you want. And I encourage you to use that as room that if you wanted to communicate something to me that maybe didn't answer that question, you could use that space to do so. Because I like bringing in whatever your questions are and answering them in a session coming up as soon as we can. And so feel free to send that information to me as well. All right. Now the question is it better to put this trade on the day before earnings? You definitely have to do it before earnings or you're going to miss the whole effect of doing it, right? If you wanted to wait till the very last moment before options closed out, you know, before the market closes on the date of the announcement, you can do that. It's not so much that it's a better or a worse, but things could change, right? Implied volatility, we know it has a tendency to ramp up a little bit. And so we could still have a little bit more ramping up of implied volatility. Well, that won't help the short straddle side, but it will help our long strangle side. Okay, so it'll just kind of be, in this case, probably offsetting to a good degree, but not necessarily entirely. So it's simply up to you. Now, in the past, one thing we have done just with doing either a long straddle or a long strangle is we have gone out even a couple of weeks beforehand with the idea of seeing the implied volatility ramp up and seeing if that helped our long straddle. And sometimes it does and sometimes it doesn't. Because sometimes, you know, maybe all the implied volatility and the expectation of movement is already priced in there that maybe it doesn't run up that much. Okay. But yes, you absolutely, in order to take advantage of it, have to do it before they announce earnings, or otherwise you're probably looking at a different type of trade. All right. A question here, can you quickly walk through what we do in both scenarios? What do we choose if it goes up or if it goes down? The answer there is going to be the degree to which it moves. Okay, we're expecting it to move. The market's expecting it to move. But say it doesn't move a whole lot, okay? That it moves less than the market maker expected move. Let's go back to the chart here, okay? So say it kind of stays in these boundaries, okay? Then we could potentially be able to keep a lot of the premium. It's not guaranteed that we could, What if it moves, say, down? Okay, let's say it moves down. Then our put spread or our put that we're short might start to feel a little bit uncomfortable. Our call that we're short probably feels really good, right? If the price of the stock really moves down this much. And so we could end up getting out a part of it, or or all of it. Okay, but we could end up just getting out a part of it. If it goes up, then our call side is probably the one that's going to be feeling pressured. Okay, especially if it goes out to that market maker move. But I think, generally speaking, although it's not always the case, we'll have a decent idea how the market's going to react to it, although it's never guaranteed, right? It could be one way after they announce earnings, and it could be totally opposite, okay, the next morning. We've seen that in this class on some of the trades we've done. It's like, whoa, okay, once they had the earnings announcement and they talked about things, then the opinion of the market changed a little bit. Okay, and that can happen with NVIDIA as well. However, this thing is going to be so watched potentially that the way that it reacts in the aftermarket that night is likely the direction that it could go, but it's not guaranteed to stay there. We've seen moves, right, where it maybe gaps up and runs and then sells off like the rest of the day. You're like, oh, if I would have sold it at the peak or gotten out of the trade at the peak, oh, that would have been better. But we really have to watch them closely. Okay. So these are kind of trades that you might put in some exits beforehand if you wanted to, based on maybe the cost of the trade, or where maybe if you're looking at where the price of the stock goes, we could make an exit based on that. In this case, we're going to watch it because we really don't know which way it's going to go. We don't know which one it's going to favor. We're hoping to capture a lot of that implied volatility as it comes crushing out of those at the money straddle. Let's see. You do not expect it to move much, Paul says. We actually know that it's expected to move some, right? 6.5%, which is a decent move. Okay, so our expectation is that it probably is going to move some, and that implied volatility is going to crush out. Riceberg says, I see boundaries similar to, like you said, to an iron condor. Now, if we go back to the Analyze tab here, and if I were to maybe, we'll test my drawing skills. Okay, my drawing skills are not the best drawing skills that there ever were. But let me just do a little bit here. With an iron condor, we typically have kind of a wider range, okay, because we put a call spread out of the money, we put a put spread out of the money. And so we typically, on an iron condor, want it to stay in this kind of a range, and it has kind of a flat top. In this case, we just kind of have a peak, okay? Knowing that 185 that we've done the strangle at, or the straddle at, the short straddle on the 185s, that's why this is the peak profitability point here, because it really is it's different than the iron condor. Okay. The max theoretical loss on this double diagonal. Well, let's look. Question is, what could our max theoretical loss look like? Well, fortunately, we're going to have a hedge in there, right? We're going to have a 190 call hedge. We're going to have a 180 put hedge, okay, which is going to limit our risk. Versus the first trade we did not have any potential protection there whatsoever. We just did it straight, just selling those options where we could have theoretically unlimited. Now, if I come out here, and let me say I just really kind of squish this together, okay, or spread it out. It looks like on this side of things, our max loss could be in the neighborhood of 280, And on this side of things, our max loss could be in the neighborhood of about, looks like 265. Okay, so something in that range, 280 to 265, depending on which side it tends to go to. All right. And then John says, I don't know if I'd do a straddle or a strangle on NVIDIA, maybe a bull call spread. That might be your preference, right? That's fine. Not a problem. Okay, so we've got a lot to be thinking about as far as managing actually both of the trades that we put on here today. Now, I hope all of you have become subscribers to our Trader Talks channel. When you do, it just makes it so easy to find our content. And I'm going to pop over here so you would be able to see what likely you might be seeing, right? Trader Talks, Schwab Coaching Webcast, that's exactly what you're going to find in here. You're going to find upcoming classes. So after this is Trading a Smaller Account with Barb Armstrong. That'll be up at the top of the hour. We also have this little section here called bite-sized content. And this is a newer, we've had it out here for maybe a couple of months now, but this is a newer one where we're doing some short videos, 10 minutes or less. Most of them are quite a bit less than that on just a particular topic. And you can see, for example, Brent Morris did one on Unlock Thinkorswim Web. That might be really helpful to those of you that like to use the web platform, or maybe you use it as kind of your backup. Maybe you use that if you don't have the full access to maybe the ability to download Thinkorswim. Looks like investors circling a trend. I don't know what that's going to be. Short, intermediate, and long-term combined is one that James Boyd did last week. You can see that's about a 9-minute video. Okay, so for you, if you go down and click on that little subscribe button in your bottom right-hand corner, it looks like a blue YouTube logo and it says subscribe. Then it just allows you to find our content easier. And then something I think a lot of you use are our playlists for our specific classes. All right, so if you wanted to go back, look at a particular webcast, maybe you missed it, go to the playlist of that class and it should be at the top of that playlist, assuming they've had time to post it after the class is over. All right. Any questions as we wrap up here? We've got a lot to really think about in this particular one. Let's see. There was one question. It looks like I just noticed that I didn't catch. Paul had said, do you expect... Oh, Paul said, I bought a long at 192.50 on December 5. Is this going to earn? Is this going to earn? It'll have an impact over earnings as well, Paul, even though it's not the week that it's expiring. Okay. All right. Well, as we wrap up here, if you do have questions, once this gets posted, you can go ahead and ask those questions in the comment section of YouTube. And I go back and look at those every day, make sure I get your questions answered as well. You know, those of you that just listened on the archive, that's your opportunity to be able to do that. Now, as we wrap up, I'm just going to encourage you to do a couple of things. One, if you fill that survey out for us, I promise I'll read every single thing you write in, and our managers will as well. We want your feedback. We want to hear. Second of all, follow Brett and I, as well as become a Trader Talks subscriber. So remember, I'm Connie Hill CS. Brett is Brett Crowther CS. Love to see your follow, and you'll have the opportunity to interact with us there as well. All right, you guys, you're free for 15 minutes. Go refresh your beverage, and then Barb Armstrong will be up right at the top of the hour with Trading a Smaller Account. We'll see you then.